Wonderful. Thank you, Lawrence. Welcome. So glad you all are able to join us for It's Happening Here. This is a webinar series sponsored by Invest New England, which is an attempt to build a collaborative impact investing infrastructure across New England. And then also my day job, the Community Investment Project, which helps place-focused foundations across the country build place-based impact investing programs. And we have folks here from New England, but we also have folks here from community philanthropy, CDFIs, all kinds of organizations across the United States and Europe, apparently. So again, welcome everyone. I want to just say a word or two about the objectives of today's session. And when you all registered for today's webinar, you shared kind of what you hoped to take away from this. There are some of you that are interested in revenue-based financing as a model for supporting entrepreneurship. Some of you are here because you're excited to see place-focused philanthropy move into the work of place-based impact investing. Our objectives here, particularly at Invest New England, is to encourage more New England foundations to explore community investing, right? And ideally to catalyze those institutions to unlock more of their assets for this kind of investment in community. And that's partly why it's so exciting to see Vermont Community Foundation here talking about the work that they've been doing now for decades to invest in their community. And then we're also hoping to prompt institutions to deploy more investments with meaningful and measurable mission-aligned community impact. And certainly Janice at the Flexible Capital Fund is going to talk about how her institution creates community impact in the work that they do. For those of you who are at foundations, you may have seen or heard me talk about this before, but the process for becoming a Vermont Community Foundation or other place-based impact investor really does start with exploration about education for your board and your staff about this work of community investing, a process of unlocking those assets through adoption of policies and processes that let your foundations do this work, and then deploying those assets, working with partners like the Flexible Capital Fund to place capital and make a difference in your community. And we'll talk a little bit about that process today. Our agenda for today's session, we're just starting here with a welcome and an overview, but then we're going to hear from Vermont Community Foundation about their community and why they got into this work. And then we're going to hear from the Flexible Capital Fund about how funds like theirs help further the mission-aligned work of foundations like the Vermont Community Foundation. And then we will have ample time at the end for questions, which you can put in the chat or you can unmute yourself and ask out loud. So we really do want this to be a participatory conversation. I'm going to start, though, with a very brief definition of sometimes we call it place-based impact investing, sometimes we call it community impact investing. But when we talk about impact investing, let's be clear that this is a huge field with trillions of dollars of assets. But we're talking about a very narrow slice of that field, right? In impact investing, you may hear about ESG or screened investing, where you screen out assets that may be detrimental to your mission. Think of a health foundation opting out of like tobacco stocks. You also may hear about activist investing. This might be where a foundation proactively buys stock in a company where it wants to show up and kind of express its viewpoint as a part of a shareholder meeting. There are also growing field of kind of topical impact investing funds. that may focus on a thing like community health outcomes, or um, uh, you'll also see a lot of green energy funds. In the field of community impact investing, we're talking specifically about investing in local companies, organizations, or funds to generate measurable community benefit. And what's interesting about this kind of community impact investing or community investing field is it happens in an ecosystem, right? And that's the collections of organizations, businesses, governments, and other entities that help make investments a reality. And that includes entities all the way that are providing capital. So that might be foundations, but it also includes some of those financial intermediaries. It includes capital aggregators, which might be a community development financial institution, a development finance agency, or a community development corporation. The capital demand, those might be the end businesses that are seeking capital, but it could also be land trusts or housing developers. And then also capital enablers, which might be governments, community college, technical assistance providers that help this whole system function. And today you'll see that Vermont Community Foundation is providing capital and is also in some ways aggregating capital through their donors. And then entities like the Flexible Capital Fund, which we'll hear from, is also being a capital aggregator and a capital demand entity in the Vermont capital ecosystem. The last thing I'll say before I hand it off to Lawrence from Vermont is I want to say a word about why foundations are doing this. Why are foundations becoming community investors? The first reason is that board members and stakeholders in communities are asking for this, right? It's about alignment of the institution's capital with its values. And in some cases, like community foundations, donors are asking foundations to be these partners. Second, some community challenges require tools other than grants. And we'll hear this from Janice, right? Some of the things that she's helping businesses do in Vermont aren't things that maybe are well suited for grant dollars, right? Some of these things require financing. Um, Third, community need surpasses the grant resources that our foundations have available, right? Um, You'll hear in a bit about how the Vermont Community Foundation has allocated 5% of their portfolio to doing this work. That means that they have millions more in resources to make a difference in their communities than if they were just a grant maker alone. And then finally, strategic investments by foundations really help unlock and leverage other capital into your ecosystem. The story I like to tell about this is the Arizona Community Foundation, through some strategic investing that they were doing in rural communities in Arizona, helped leverage tens of millions of dollars of USDA rural development dollars into their state, right? So by stepping in and providing bridge or strategic capital in your ecosystem, you can pull in millions of other dollars to do the good work in your community. So with that, I will take down my slides and I will hand it over to Lawrence at the Vermont Community Foundation. I'm not going to provide an intro, just to say thank you, Lawrence, for being here with us, and look forward to hearing what you have to say.
And I think it might be helpful if I explain a little bit of how I came to this work. I moved to Vermont in 1989, right out of college. I thought I'd get a job in a brewery, but there weren't any jobs in breweries. There were only a couple of breweries, so I started one. And, part of what motivates me is that I got so much help as a startup from people in Vermont. It was really extraordinary. And I wound up getting involved in local and then statewide community and economic development as a result of that, um, including spending some time as the state secretary of commerce and community development, and working in different forms of capital formation and really, it's been an extraordinary place to live and raise my kids and be in different businesses. So I have an independent consulting practice doing strategic consulting and business coaching, helping organizations and individuals create change. I spend about half my time with the Vermont Community Foundation, and this has been for the last several years. Helping them manage the mission investment portfolio there, and I'll talk a little bit about how that came to be, and and some of the things that we are trying to accomplish. Historically, community foundations invest in the public markets and use those earnings to support grant making. So the goal of our major pools is to earn enough money to preserve purchasing power net of grant making expenses and inflation. For about 2001, the VCF board decided that they wanted to allocate 5% of the corpus to direct investing in Vermont. I use the term mission investing related to this because this is the part that is fully aligned with our mission to help Vermonters thrive and to give opportunities and help create opportunities for Vermonters who might not otherwise have them. This was really driven by a couple of entrepreneurs who were on the board at the time who had had difficulty raising capital. There wasn't a lot of diversified capital available in Vermont. You had bank lending and friends and family. About that time, the first real venture firm in Vermont got going, Fresh Tracks. VCF took a initial position in that first Fresh Tracks fund to help them get going. And since then, we've really looked for ways that we can invest and participate to help things happen that wouldn't otherwise happen without our participation. So that's really what drives us. Our return objectives for this part of the portfolio are essentially neutral. We're looking to preserve purchasing power net of losses, expenses, and inflation.
It's
The
but
mission itself is what we're looking for out of this. So you think of this as market returns adjusted for risk and then adjusted for social impact. We don't use a discrete scoring metric. I bring recommendations to a Vermont portfolio committee, and we let them use their judgment to say, yeah, this feels like a 2% return is appropriate because of how much impact we're getting. That might be something like a affordable housing project where we're providing capital for the early development stage. But we also invest through a lot of intermediaries, and our goal with those ranges from high impact to mixed impact to financial support. So you can think about the mission investment portfolio the way I do. It's a little bit of a barbell. We have some things that provide very good returns that support some of the things that have programmatic losses built in. And we do all of this largely subjectively. But what we do with all of this is we try and keep it well aligned with our grant making objectives, what we call the opportunity gap, and the areas where the organization is really trying to help create opportunities for Vermonters. So we look at that in an aligned way. So this 5% pool has been around since 2001. Along the way, we've also accumulated some other investments, things that were donated to VCF or fall outside of the 5% pool. So we call the entire pot the Vermont portfolio, and the 5% allocation the Vermont pool. We are now moving forward towards creating an opportunity for people to allocate more to the Vermont pool and to sponsor a specific investment. So rather than pairing them and saying, okay, your DAF can be invested in a specific thing, you can take some of your DAF or new money, put it in a mission investment fund, and then recommend further investment in something like the flexible capital fund so that we can let people increase and participate, but we maintain the diversification of the pool because we believe that diversification is an important investment principle. Graphically, the Vermont pool is the lion's share of it. And by the way, we do this with a 5% allocation when a new fund is created or with major new contributions. We don't try to rebalance all the time. The Vermont pool is largely illiquid investments, right? We are not counting on this for grant making revenue. Consequently, particularly in our loan portfolio and in our fixed income, we can do a lot of loan modifications because we're not counting on it for liquidity. So our loss history is basically nil. And this isn't extend and pretend or delay and pray the way we think about it in the banking world, right? This is really being able to be active with our investments and continue to let them evolve in the way that's most important for the people we're investing with. It's grown considerably over time and continues to grow. The bottom here, we've got a little bit of a chart that includes the um, dominant areas here that we think of as the opportunity gap areas. So our investment in the flexible capital fund, for example, is driving at clean and healthy ecosystems, entrepreneurship, food and farm. The Vermont Sustainable Jobs Fund, which sponsored the creation of the flexible capital fund, was a created by the legislature and has four impact areas themselves that they're expected to play within. So those extended to the creation of the Flexible Capital Fund. For full disclosure, going back years before I got involved with VCF, when Janice and VSJF were thinking about creating this, I helped. And we went on a very fruitful visit with John Hamilton, who I see was on the call, and really got a lot of learning from others who were already in this space. So we're happy to pass that learning along. Um, we use a variety of tools, as I said. So fixed income is our lending program. A lot of that is to nonprofit organizations in Vermont. We do things like project acceleration loans that I think of as project acceleration loans, for example. We can lend against pledges. A bank won't lend against pledges. We can lend against grants, but a bank will do that, so we don't often. If we see a project that is sort of time sensitive, but somebody needs to do some extra fundraising, we can come in and bridge that. So we do a chunk of that. We do some equity investing. We don't do a lot of that anymore. Those were some interesting experiments. Better for our intermediaries to do that now that there are plenty of funds. Like Janice on the landscape, we don't need to do that direct work anymore. So our default is to refer people to the funds that we work with rather than to do it directly. But there's a little bit of that in there. The venture capital tool is the bucket that we put the flexible capital fund in. I will say I don't think Janice considers herself a venture capitalist. It's the term we use, and maybe local fund managers would be a better term. Um, I will say, though, for a long time, we only invested in funds that were exclusively active in Vermont. We are in a regional economy. Well, we're in a global economy, but the matrix in the areas that we work, it's definitely regional, right? We have Vermonters who work in New Hampshire, Massachusetts, and New York. We have businesses that require that access markets in those areas. The food system is regional. All of these things drive towards regionalization. And we also want to attract funds to Vermont to do business here to make capital available who might not otherwise. So a few years ago, we broke down that barrier and said, yeah, we will invest in cross interstate funds. But what we're going to do is fulfill our promise to our donors by using a side letter that says they're going to use their best efforts to make investments in Vermont for our funds, matching our funds as well as any other geo-targeted funds for Vermont. and we just test that at the end of the investment period. We're not asking them to pair it off or meter it out. We don't, we'll just standard capital calls, keep it simple, but it gives us a tool to make sure that we're fulfilling our donor promise relatively efficiently. Um, we also sometimes co-invest with our fund managers as well. So if they've got a specific investment, they're developing a sidecar to deepen an investment, we will go ahead and do that. The reason we're doing all of this is because grants don't fulfill all of the needs, and there is not all of the capital that's required. Janice will bring up the capital continuum when she speaks, but there just isn't always a great match. And the way our CEO Dan Smith puts it, when we give a community a grant, we're saying we see your need. When we make an investment, we say we see your potential, and it's a very different aspect. So it's become an important part of what we do, important for us as an organization, and important for our donors as they look to different ways to have an impact um, in in Vermont and their specific communities. So I'll pause there, and I don't know if anybody's got an immediate clarifying question, or we'll come back to questions after Janice.
Thank you, Lawrence. And I think we will hear from Janice. I did just want to ask, you're one of the foundations that actually has a track record that you can look at, and I'd be curious if you can say over the life of your fund what your return has been, and have you had any losses?
So
Two common questions in impact investing.
you bet. So over the life of the fund through last year, our return has been 2.7%. So we're over that time, inflation was very low. So when you look at that, we're achieving our objective of preserving purchasing power net of inflation. We're looking for some increased yield now with inflation a little bit higher, but we're not looking to radically change that performance. Um, and as far as expense goes, last year, fund administration cost about 71 basis points. So it's not a tremendously expensive activity. I'm an outsider. I spend about half of my time. One of our accountants spends probably close to half of their time. I'll look to Barry for clarification, but it's a meaningful activity set. It does, take a chunk of time for the auditors because this is some odd stuff in here. It's a very much contact sport, and it's a group contact sport. We are working with our intermediaries, with our borrowers, helping them find alternatives, sometimes interacting at a public policy level on housing, on education, on environmental issues. It's across the spectrum. So when I show up, it's not just, hey, can I place some money here?
Yeah.
It's can I help you achieve your objectives? If we can do that without placing money, that's also fine. That's time well spent. So in some ways, the foundation is sponsoring me to go out and do community and economic development work. If we can place money, more the better. Um, but I do think one of the reasons that funds like this don't have significant losses. I mean, obviously, there are losses within each of the portfolio elements of our intermediaries. Losses are a normal part of investing. But in the stuff that we've done with our direct lending program, because we can be super flexible, we don't have losses. We haven't. And we can be more flexible because we are making our own fiduciary judgments. And that is something that a fund manager, a third party, can be constrained of their obligations to the investor. So, I sit on a bank board and we can't do the kind of loan modifications in that regulatory environment that the foundation can do with our borrowers.
It's a great example of how bringing your values and your mission to the work of finance changes the way you invest in your community. Well, Great. Thank you, Lawrence. And we'll have time at the end for questions, and folks can put them in the chat, or when we've heard from Janice, you can come off of mute and ask questions. But Janice, it's so wonderful to have you here. I think this was originally an idea that we had months ago, and I'm so glad that we get to hear the Flexible Capital Fund story. So take it away.
Thanks. Thanks so much, Travis. Appreciate being here. I'm gonna get my slides up here and share. Can everybody see? Hopefully. All right. Well, this is just the cover sheet anyway, so we'll move on. So again, Janice St. I'm the president of the Flexible Capital Fund. We have a mission of creating healthy food systems, preserving working lands, and building resilient communities. And we do this by addressing climate change through our investments in companies that are providing regenerative solutions and equitable workplaces. So it's a little bit of a mouthful, but I think it's in a nutshell what we're trying to do with our capital. We've got a 12-year track record. Lawrence had mentioned that we spun off of a nonprofit organization called the Vermont Sustainable Jobs Fund back in 2011 when we saw a real need in the marketplace for flexible risk capital that just wasn't available to companies in our sectors, in the food, forestry, and climate change solutions sectors. We're also what's known as a Community Development Financial Institution, a CDFI. So we got certified in 2014 to be able to access U.S. Treasury dollars to support our work in underserved communities in Vermont. We're women-led and managed. My colleague Casey Johnson is on the call with me today. We're mission-driven with financial returns. And last but not least, I think we're a leader in innovative investment structures, primarily revenue-based financing, which I know a lot of folks on this call were interested in learning a little bit more about. And I did want to also mention John Hamilton as one of our early on mentors and RBF investor extraordinaire, where we had done a lot of groundwork to understand what RBF was and why it was such a great instrument for companies growing in rural communities. All right, so I think I'm dating myself a little bit here. I don't know how many people ever read Dogbert, but he was one of my favorite dogs. And his cartoon, I thought this was appropriate because this is really, if you think about it, this cartoon is probably 15 years old, but we're still kind of in the midst of this financial services game, and a lot of products, it's hard to understand them, let alone imagine that they're real. And then, who knows whether you're getting real advice or not. So we were really looking at slowing down the pace of capital, being real with it, bringing humanity into the investing that we're doing and making systems change. This is what we're about. So for the Flex Fund, this is our thesis and focus. So we are sector specific. We're looking again at building healthy food systems and mitigating climate change. And we do this by investing in food systems, forest products, clean technology, waste management, climate change, water. It's pretty broad, but it's all about focusing on those ideas of that we need to make systems change in our food and how we grow it, how it gets to our table, and mitigating climate change and reducing our carbon emissions. Our primary focus is early and growth stage companies that are solving these critical issues that we're facing right now. Our geography is Vermont, but we're now extending to all of New England, where we can go in to deals with trusted mission-aligned partners. And our structures, while we are absolutely primarily focused on using revenue-based financing as a non-extractive alternative to equity, we do take an integrated capital approach, which means that if revenue-based financing is not an appropriate structure for the companies that are highly mission aligned, we will consider other types of structures, self-liquidating equity, convertible debt, warrants, hybrid, any combination thereof. So our investment range is between 100 and 500,000. We do have a number of partners that have come in and invested alongside us, again, including the Vermont Community Foundation, other CDFIs like the New Hampshire Community Loan Fund, Coastal Enterprises of Maine. And focus is really on permanent working capital. So we're the kind of capital that doesn't require collateral, doesn't require a personal guarantee. It's really meant for companies that are growing and need to hire people. They need sales and marketing dollars, things that a traditional lender or bank aren't going to lend on because they are looking for collateral to secure a lien on. They're looking for a personal guarantee that they can secure with a second mortgage and looking for the firstborn child, et cetera. So like we are not collateral driven. And personal guarantees, while they help ensure the entrepreneurs at the table, we've found that they're not a guarantee of repayment. So we don't require them if it's not appropriate. And our typical term of our revenue-based financing notes, and it is debt, is anywhere from 5 to 7 years. We can go longer if we need to, but that's typically we'll check in. If it hasn't been repaid in 7 years, we need to figure out if there's a better structure for that investment. So I just wanted to focus for a moment on why revenue-based financing is a higher risk kind of capital and how we can do this using the kind of capital that comes in. So how flexible the money that we raise then in turn determines how flexible and how much risk we can take in investing in businesses. So flexible capital in means flexible capital going out. When we started this fund, we recognized that if we were to take on traditional debt, like many CDFIs do, low-cost loans, et cetera, we would be locked into a monthly principal and interest payment that would then prevent us from really being creative and innovative with the kind of structures that we needed to provide to those companies who are making systems change. So in Fund 1, we raised $4 million in mission-aligned patient equity. So not debt, but equity. So our Fund 1 members are owners in the fund. They have invested equity, they have an ownership position, and they are mission aligned in that they're looking for us to make change in these sectors. Then we took on another $2.5 million in CDFI capital, and that was non-dilutive. So that came in as grant dollars to us, which means that we could be even more flexible, take even more risk because we could put capital out. That CDFI money also provided us with loan loss reserves, with business coaching dollars that were really, really important in this kind of investing. And then I would say philanthropy has truly risen to the challenge. The Vermont Community Foundation has been our foundational partner and co-investor all along the way. They believed in us in Fund 1 when we were a fund that had never done this work before. Nobody was doing revenue-based financing investment in Vermont. And they believed in us because they knew our partner, nonprofit partner, the Vermont Sustainable Jobs Fund, and they knew we were in alignment with the work and could support the work that the VCF, the Community Foundation, is doing here in Vermont. So right now we're raising capital for Fund 2. And that's in progress, and because we're winding down Fund 1, but the Vermont Community Foundation has stepped up once again as an anchor investor. So we're excited to have, again, that flexibility of capital coming in to ensure that we can continue to do this work. So what is revenue-based financing? Well, it can be used as debt or equity. We use it as debt, but it can act like equity. We take a percentage of sales, not of ownership. We get repaid based on that percentage over time until we reach a fixed time period or until we reach a set return. It's less expensive than equity, but it's not low-cost capital. So to give you an example, we're looking at anywhere from 1.7 to 2.2 times our money, a multiple on our money in return from the companies that we invest in. An angel investor is looking at anywhere from 3 to 5 times their money, and a venture capital fund is going to be looking at 5 to 10 times their money over a shorter period of time. So we're going to be less expensive than venture or equity, more expensive than a traditional CDFI who might have a 7% note for 5 years, but then you're locked into a fixed principal and interest payment. We aren't forcing an exit strategy like an equity investor would. With equity, you have to have an exit in order for the investor to get their money back. And we are one more option in that capital continuum. So why is revenue-based financing a great tool? Well, I think it's a really good option when good companies who have a good team, they have a market opportunity, and they have good margins, they are getting turned down by banks for things like they have a hiccup in their sales or profitability. They don't have sufficient collateral, or they have specialized collateral, they have concentration of sales, or they don't, the entrepreneur doesn't really have anything behind their personal guarantee. And it's also good for companies that can't or don't want equity because they have no clear exit plan. They want to grow this business organically or sustainably. They don't want to dilute ownership. They want to keep the wealth in the business and therefore with their employee base. Their market and growth projections are not going to be, hockey stick related. They're going to be, anywhere, 20 to 30% year over year versus 50 to 70%, which is what equity and venture is looking for. Oftentimes, entrepreneurs want to preserve their freedom and control. Equity investors will typically want to have a seat on your board, and that means decision making. And then, also with the existing capital structure, maybe it just can't support having equity investment. So this is the capital continuum that Lawrence was referencing. It's a little bit of an eye chart, but it gives you a sense of kind of where we sit in that continuum of capital that's out there. This is not comprehensive, but it gives you an idea that the lower risk, meaning lower reward, lower cost money for a business is going to be on the left-hand side. And as you come up the continuum, based on the structures, you're going to have higher risk capital that's going to ask for more return on their money. And not just return, but how patient they can be with that capital. So we sit somewhere in the middle. Revenue-based financing is higher cost than traditional subordinated debt or bank debt. It's lower cost than equity investment, convertible debt, and a safe note, which is in between a convertible debt and equity investment structure. So here's an example, a little bit of a case study here. In 2016, we invested in a company that was at the time called Northern Reliability. They're an renewable energy battery storage company, and they had some growing pains and lumpy revenues. And they needed working capital to grow and seize the market opportunity in energy storage. So if you can imagine, this is, as renewable energy is becoming less and less expensive, more and more cost effective, storage is really the nut to crack to ensure that renewable energy was here to stay and could do the work that it needed to do. So we saw the opportunity. We understood that they just couldn't get bank debt. Banks weren't going to lend to them based on their operating history. They were really project focused versus productized focused. And the equity, they were looking to raise equity, but it eventually came off the table because they just didn't have the kind of valuation that would make sense to raise more equity and further dilute their early investors. So we came into the deal. We provided them with $450,000 in revenue-based financing. It functioned like equity, but without the ownership dilution. So it helped give them that permanent working capital they needed to hire the people for the pipeline that they actually had demonstrated on the books. They paid us 2.4% of gross monthly revenues. We got 1.9 times our money back in 7 years. And in 2021, that note was fully paid without any further dilution of that business. So again, multiple less than an angel or venture capital expectations, but we gave them room to grow. We gave them breathing room to grow and get off that runway, right? The results, so fast forward in 2022, Northern Reliability merged with Core Power, which is a national battery storage company in 2022. The jobs at the Core facility in Vermont remain in Vermont, and they're continue to provide good paying jobs and actually growing. When we invested, I think they had 20 people at their facility in Waterbury. They're now close to 100 employees with good paying quality jobs, providing critical infrastructure in the renewable energy storage space. And they continue to innovate. They spun off a company called Nomad Transportation Systems that has created a mobile energy storage unit for utilities that can move around and kind of ensuring that smaller utilities have access to storage they might not otherwise have. And then what I failed to mention was early on with the structure of our investment in our RBF note, we actually had warrants to buy future equity in the business because we saw the opportunity and we said, okay, if there's upside, you know, we don't ever have to, if we don't ever exercise our warrants, that's fine. We'll still get our upside, our 1.9 times our money. But if there is upside and they do merge with another company, which they ended up doing, we'll exercise our warrants. And so we continue to have an investment in both Core Power as well as Nomad Transportations as equity investors, very, very small equity investors, but we have the opportunity for that upside down the road. So this is a little commercial for the Flex Fund from Jay Bellows, the president of Core Power. Like I said, we came in with that capital that helped them ramp up their sales and marketing and hire the employees and invest in the product development that they needed to really grow and be successful. So what are the benefits of revenue-based financing to investors? I think this is the one thing I wanted to make sure I covered. So there are benefits to the entrepreneurs that we're investing in having this kind of structure. It's patient, it's lower cost than equity. We don't take the ownership, and we are in partnership with them. But to investors, for our investors, what we're demonstrating is that this kind of capital fuels more sustainable companies, leading to more durable returns and impacts. We're playing Moneyball. We're not playing to make home runs. We're playing to get second and third base hits, right? It's adaptive. I can't say the word adaptable to economic cycles. So think about the pandemic. So when the pandemic happened, a lot of our food system businesses were working with restaurants that shut down overnight. No revenue, no payment, no default for those companies. So it was really adaptable. It supports resilient companies and we are aligning the incentives of the borrower and the investor. It's a win-win for both of us. It's a self-liquidating instrument that doesn't require an exit strategy. So in a traditional venture fund model, an LP or an investor will get their money back when there's an exit or a sale of the business, right? And that could be 5, 7, 10 years. It could be never. For us, because we're getting a monthly revenue share payment, we started distributing capital back to our investors in year 4 of Fund 1. And yes, it's lower returns than equity, but it's higher than traditional term debt, right? Because we do have the opportunity for some upside. Sometimes traditional equity is needed. It definitely fuels high growth companies on a very fast trajectory, but it requires that continued growth that may not always be sustainable. Like we have finite resources on this planet. Sometimes it's not sustainable to grow exponentially. Equity does offer higher upside, but it's a liquid and it requires an exit strategy. It provides ownership and possible decision-making, but it is absolutely less available to sustainable impact businesses. And no Vermont presentation would be complete without a picture of cows and a wannabe cow. That is my dog Zeke, who has since passed away, but I thought he looked just like a cow in that picture. So just for a little entertainment there. And then, as I mentioned before, we are in the process of trying to get Fund 2 off the ground. And so looking for those folks who want to learn more about what we're doing. So with that, I'm going to stop and I'll turn it over to you to Travis for questions.
Thank you, Janice. And such a cute dog. Questions for Janice or Lawrence that folks have, you can put them in the chat. You can come off of mute and ask them out loud, however you'd like. And while folks are doing that, and you can raise your hand, Janice, I did just want to ask, I know a lot of foundations care about firm transitions. Is revenue-based financing a tool that's appropriate for kind of ownership transitions of enterprises, and any of the companies in your portfolio are firm transitions?
Early on, and I'm not necessarily for employee ownership type of transition, but what I
Hmm.
would say is we had a company early on that was spinning out of a larger company. They were taking some of the sales pipeline and IP with them, and even though they were in startup business, they already had a pipeline. They already had the same team. So we were able to provide them with a revenue-based financing note to make that happen. There's no way they could have gotten traditional debt to do that. And the entrepreneur didn't want to dilute ownership. So it was a very good tool for that.
Question in the chat is, what is the typical size of an investment that you seek via the RBC model?
So we're deploying anywhere from 100 to 500,000 from our own capital. If a company needs more than that, we've brought in other participants, other CDFIs to co-invest with us or to participate, meaning purchase a portion of our note. So for one company early on that needed $1 million in permanent working capital, we did 400,000 and brought in three other mission line investors that purchased a component of the note to get them to that $1 million revenue-based financing note that they needed. So but I would say that typically anything more than $1 million in RBF dollars is probably a stretch because it's going to take that company, depending on where they start in their where they start with revenue, it will take them a long time to get any kind of multiple on that money over, 7 years or so. So the maximum, that $1 million RBF note is probably the largest that we have done in any one investment.
Other questions? Yes, Hannah.
Hi, thanks very much. This was really helpful. I'm Hannah from the PV Grows Investment Fund out of Franklin County CDC in Massachusetts. So we provide debt capital to a lot of small farms and other small businesses in Western Massachusetts. Do you find that there are some that businesses they're hesitant to do RBF because they're just not familiar with that financing model? They're just used to debt financing. They go to a bank, or they haven't probably been able to go to a bank, but that's just what they're used to. So like, how much education have you had to do with those businesses to explain this model?
A lot. It's part and parcel of what I do, and that's why the capital continuum is very helpful for folks to understand. Because oftentimes there's companies need more than one kind of capital as they're growing. They may need a term note to purchase a piece of equipment. They may need RBF capital to do the permanent working capital component. They may even look at equity down the road to finance things that really, because they might have too much debt on the balance sheet. So there's a lot of education in helping them understand what revenue-based financing is and what it's not and when it's appropriate. So from my perspective, and this is a lot of what John Hamilton taught me to his credit, is that RBF is a great structure for companies that have sufficient margins that can take a percentage of revenue right off the top, the gross profit margin. So if you're a farm or a retail store that traditionally does not have strong gross profit margins, it's probably not a good structure, right? And it's not a good structure for startups because, well, startups don't have revenue and you need revenue to pay us back. So hence why we're looking at early and growth stage companies that have demonstrated a sales pipeline, that have some sales under their belt. But it is an educational process and helping them understand where it fits. Not just the entrepreneurs, but the other investors and lenders too. I think RBF has gotten more and more play over the last couple of years at a national level, so more and more are learning how to use it. But it's still not the go-to instrument like that you would think it could be, because it just is such a great tool when you've got companies that don't want to dilute ownership, that want to grow sustainably in their community.
Question for Janice and Lawrence is, what are your thoughts on fund management fees for smaller high support funds? Is 2.5% unreasonable? Um, or are your management fees subsidized through non-dilutive support?
So from an investor perspective, I'm fine with higher fees for a smaller fund that is providing high touch. We have intimate experience with how much is involved in technical assistance and coaching and the time you've got to spend. And if you've got a small fund, right, it's just a you've got to be able to take the time. And if you're making a lot of small investments, they each have the same level of overhead and handholding involved as larger investments. So it's just going to be natural. We are looking at, what's the net return after expenses, right? So that's what we're reporting from an investment perspective. Our 71 basis points expense load in the Vermont portfolio, that's just our internal expense. Each of our intermediaries are charging, and we look at their returns net of expenses. But if you show me a business case, why you need a higher fund ratio, management ratio, and it's aligned with what we're trying to accomplish in the space, we're not going to say no just because of that. You're just going to have to be able to show us. Certainly, wherever you can get grant support and other support for some of those elements, though, and you can lower your broadcast management fee, it's going to look better.
And
And I'll address that directly because that is the conundrum because Fund One was clearly a very small fund. We did not cover our management expenses. So we were fortunate enough to have a nonprofit organization that supported us. And that should not have been the case. Where we could get grant dollars to support and offset operating expenses, we did in the past. And that's why becoming a CDFI was so important because there are a component of that award that we can get on a regular basis from the CDFI fund provides a small component for operating expenses. So that would offset the management fees. That being said, Lawrence hit it on the head. This is a high touch kind of investing, and it requires really having and being in partnership with the businesses that we work with. And so that means business coaching, that means technical assistance, that means my time, another fund manager's time, and that costs money. So there's a minimum that it really takes to cover those costs at a percentage. And so I'm not shy to say that Fund Two, our management fee will not necessarily be 2.5. It might be 3, it might be 3.5, depending on whether we get CDFI on money in to offset that. But that's what it takes to do this work. And then the last thing I will say is remember, impact funds are providing financial, social, environmental returns. So weighing those and understanding that they're all equally important, impact first, is really critical.
And I think there's another element to this work that I want to call out in the governance side of things. This is not the same investment committee as another type of investment committee, right? And so for our mission investments, we actually have a separate Vermont portfolio committee that's made up of people who really think about small businesses, community development. They have a different kind of background than the highly sophisticated, very skilled allocators we have on our principal investment committee, right? These are different activities. And for an independent fund like Janice's, both the board and the investment committee need to be aligned with a clear understanding that they're not sitting there on a bank board. They're not sitting there on a traditional investment committee and be able to take her recommendations with an understanding of that overall mission. That's a different type of human.
so there are some questions in the chat that we won't get to, but if you keep putting your questions in the chat, I will ask Janice and Lawrence to provide brief written responses, and I will share those out with everybody with the slides after the session, including their contact information as well. But there is one question that gets to the impact that I did want to ask both of you. Janice, can you talk a little bit about how your fund reports and thinks about impact? You told us about the kind of sector focus and the mission of your work. And then Lawrence, if you could also just say for your Vermont 5%, how do you talk about and report impact to your fund holders and your board?
Um, I'm coming off of having watched a webinar yesterday that Sally Calhoun was in with Esther Park of Cienega Capital and the No Regrets Initiative. And Sally was asked that same question. She's a philanthropist and has done so much in the space of impact investing in regenerative agriculture. And she said, I get that question all the time. And we don't officially measure impact because it's all impact. It's all, everything that we do is impact, whether it's financial, social, or environmental. So, like that being said, I understand where the question's coming from. We do an annual impact survey with our companies, with our portfolio companies, and that is interesting because they're all at different levels of competency in collecting data that we're looking for. There's some basics that we look at. Are they growing their revenue? Are they improving margins and getting to profitability? Are they providing living wage jobs, which we measure against the MIT's wage survey for each state that we're investing in? Are our dollars helping them leverage other dollars to grow the business? What's the diversity of the team look like? How much are they spending in the local supply chain? With local vendors? Like we are measuring those things to tell a broader story about the fact that these are community businesses that are reinvesting in the community, providing living wage jobs, with diverse entrepreneurs that are using our capital to actually get additional capital to grow and be successful. And the other component of what they're doing is they're providing products and services that are building healthy food systems, putting food on our table, reducing carbon emissions. So those are the kinds of things that we try and get at. We have anecdotal data that we collect on an annual basis, and then we have the hard data. But it never really tells the true picture because all these entrepreneurs have different visions for their businesses. And I wish we could tell the story of each one of them every year. But the impact report is for investors to help them understand, here's what your money has been invested in, and here's how you can see how it's impacting your communities that you care about.
And I'll be really brief because we're at the top of the hour. We rely on qualitative analysis and storytelling. Quantitative efforts, very, very, very challenging to do effectively. But we rely on the qualitative and we keep that aligned with the same way we talk about our grant making so that it's coherent for our donors.
Thank you, Janice. Thank you, Lawrence. It was so wonderful having you here to talk about your stories and your work. I will say I will provide all those materials, including the recording, the slides, and answers to the questions that we didn't get to on the website following this, as well as email for Janice if you have, or Lawrence if you have any questions. And then I'll say that this webinar series happens every other first Thursday, and our next one is on August 7th, and we'll focus on Indigenous and Native CDFIs in New England and how philanthropy is showing up to support that important work in New England, and look for more information about that. Again, thank you, Janice, Lawrence. So wonderful for you to share your stories today.
Thanks so much for having us, Travis. I did, just for anybody who's still in the call, I put a link to our website that has all of our stories of our portfolio companies. So if you want to dig a little bit deeper into their impact.
Thank you, Janice.
All right. Thanks so much.
All right. Bye-bye all.
Awesome. Bye-bye.